At 6:42 a.m., the first confirmations began to surface a coordinated U.S. naval presence was tightening across critical shipping lanes, and within minutes, global markets and governments realized something far bigger was unfolding. What initially looked like a routine military positioning quickly revealed itself as something more aggressive, more strategic, and far more consequential. A de facto naval blockade was forming, aimed at restricting Iran's ability to move its most valuable resource, oil. In modern geopolitics, that is not just a military maneuver, it is economic warfare at scale. The waterways in question were among the most important on the planet, carrying a significant share of the world's energy supply. Even the suggestion of disruption in these routes has historically been enough to rattle markets, but this was not speculation. This was movement. Warships repositioned, surveillance increased, cargo traffic slowed, insurance costs for tankers began to spike almost instantly, and within hours, shipping companies were already reassessing routes, calculating risks, and preparing for potential delays that could ripple across the global economy. Washington's official messaging was measured, emphasizing security concerns, regional stability, and enforcement of existing restrictions. But behind the language, the intent was unmistakable. By tightening control over maritime access, the United States was targeting Iran's economic lifeline. Oil exports are not just a revenue stream for Tehran, they are the backbone of its financial system. Restrict them, and the pressure spreads quickly from government budgets to businesses and ultimately to ordinary citizens. That is the power of a blockade. It does not need to fire a shot to have impact. The impact is built into the system it disrupts. Tehran responded cautiously at first. Officials issued statements condemning what they described as unlawful aggression and warned of consequences if the pressure continued. Military spokespeople hinted at defensive readiness but stopped short of immediate escalation. That restraint was strategic. Iran understood the stakes. Any direct confrontation in such a sensitive corridor could trigger a wider conflict, drawing in regional actors and potentially spiraling beyond control. But restraint does not mean weakness. It often means calculation. And calculation was happening on all sides. In the background, tensions involving Israel added another layer of complexity. Intelligence coordination, defense readiness, and regional positioning all became part of the same unfolding picture. While the blockade itself was centered on Iran, the broader environment was already charged. This was not an isolated move. It was part of a larger strategic chessboard where every action carries multiple consequences. Markets sensed that immediately. Oil prices began climbing within minutes of the news spreading. Traders know that supply disruptions, even potential ones, can reshape pricing expectations overnight. The fear was not just current supply, but future uncertainty. If tankers hesitate, if routes change, if insurance becomes too expensive, the entire energy system feels it. And when energy markets move, everything else follows. Transportation costs rise, manufacturing margins tighten, inflation risks increase. The shock travels fast. Financial networks lit up with breaking alerts. Analysts rushed to interpret the move, debating whether this was a temporary show of force or the beginning of a sustained economic siege. Some argued it was a calculated pressure tactic designed to force Iran into negotiations. Others warned it could provoke exactly the kind of escalation it was meant to avoid. In geopolitics, actions rarely stay within intended boundaries. They expand, react, and evolve. Inside Washington, emergency discussions were already underway. Officials monitored not just military developments, but market reactions, diplomatic signals, and intelligence updates. The key question was control. Could this pressure be managed, or had it already crossed into something more unpredictable? That uncertainty is what makes such moments dangerous. Not the action itself, but the chain reactions it triggers. For Iran, the implications were immediate and severe. A blockade does not need to be absolute to be effective. Even partial disruption can reduce export volumes, increase transaction costs, and weaken confidence in economic stability. Businesses hesitate, currency markets react. Investors withdraw, citizens begin to worry. Economic pressure becomes internal pressure very quickly, and internal pressure can reshape political decisions in ways external actors cannot fully predict. By midday, the global narrative had shifted. This was no longer just about ships in the water. It was about leverage, control, and risk. The United States had demonstrated its ability to project power across critical trade routes. Iran was signaling it would not accept that pressure without response. Markets were bracing for volatility. Allies were watching closely. Rivals were calculating their next moves. The entire system was adjusting in real time. This is how modern conflicts often begin, not with a single explosive moment, but with a strategic move that changes the balance underneath everything else. A blockade is not just a line in the water, it is a signal. It tells the world that pressure is being applied at the highest level. And once that signal is sent, it cannot easily be taken back. By the time the day was ending, one consequence was already becoming clear. The pressure was working, but not in a contained way. It was spreading through financial systems, political calculations, and public perception. And in Tehran, the first visible crack was already beginning to appear. Within hours of the naval blockade tightening, the first visible crack did not appear on the battlefield, it appeared in the currency market. Iran's financial system began to react with a speed that surprised even seasoned analysts. The Iranian rial, already under pressure from years of sanctions and instability, started to fall sharply. But this time, the decline was not gradual. It was immediate, aggressive, and deeply psychological. What had been a fragile currency suddenly looked like it was losing its anchor entirely. By the end of the day, exchange rates had spiraled to record lows, sending shockwaves through Iran's economy and turning a geopolitical move into a domestic crisis almost overnight. Reports indicated that the rial plunged to historic levels, crossing nearly 1.8 million per US dollar in open market trading, a dramatic fall that reflected both economic reality and public panic. AP News 1. The speed of the collapse mattered as much as the level itself. Currencies can weaken over time without triggering chaos, but when they fall rapidly, they create fear. And fear spreads faster than inflation. Inside Iran, that fear translated into action. Citizens rushed to convert their savings into dollars, gold, or any asset that could hold value. Exchange shops became crowded. Informal markets heated up. Prices changed not weekly, but daily, sometimes hourly. The currency was no longer just losing value, it was losing trust. And once trust disappears, stabilization becomes exponentially harder. The root of the collapse was directly tied to the blockade. Oil exports are the primary source of foreign currency for Iran. When those flows are restricted, fewer dollars enter the system. At the same time, demand for dollars rises as businesses and individuals seek protection from uncertainty. That imbalance, less supply, more demand, pushes the currency downward. But in crisis conditions, the effect multiplies. Traders anticipate further declines, which accelerate selling. Households panic, which increases demand for foreign currency. Businesses adjust prices, which feeds inflation. The system begins to spiral. This is exactly what Iran was experiencing. Inflation, already high, surged further as the currency weakened. Essential goods became more expensive almost immediately. Imported products, medicine, food items, industrial components saw price jumps that placed them out of reach for many families. Even domestically produced goods were affected because their inputs often rely on global pricing. The result was a sudden and painful squeeze on purchasing power. Analysts noted that inflation was already running above 60% annually before the latest escalation, meaning the economy was entering this moment from a position of extreme vulnerability. Reuters 2. The blockade did not create the crisis, but it accelerated it dramatically. The psychological dimension was just as important as the economic one. In currency markets, perception can drive reality. When people believe a currency will fall, they act in ways that cause it to fall faster. That dynamic was visible across Iran. Businesses began pricing goods in dollars or adjusting prices constantly to keep up with exchange rate changes. Workers demanded higher wages to offset inflation, putting additional pressure on companies already struggling with rising costs. Savings lost value quickly, eroding financial security. The rial was no longer functioning as a stable unit of account, which is one of the most dangerous phases for any economy. The government attempted to respond. Officials signaled intervention plans, hinted at currency controls, and explored mechanisms to stabilize the market. But such tools are often limited in effectiveness during high-pressure situations. When confidence is shaken, administrative measures rarely restore it quickly. Iran's central bank faced a difficult choice: spend reserves to defend the currency or conserve them for essential imports. Either option carried risks, and with export revenues constrained by the blockade, those reserves were already under pressure. The broader economy began to feel the shock in multiple layers. Industrial production slowed as input costs rose and supply chains became uncertain. Small businesses struggled to keep up with fluctuating prices. Larger companies faced declining demand as consumers cut spending. The banking system experienced stress as deposits lost real value and lending conditions tightened. This was no longer just a currency issue, it was a systemic economic shock unfolding in real time. Social consequences followed quickly. Economic crises rarely stay contained within financial systems. They spill into daily life. Rising prices, shrinking incomes, and uncertainty about the future create frustration. In previous periods of currency collapse, Iran had seen protests and public unrest. The conditions now looked similar, if not more severe. The difference this time was the speed. The collapse was not unfolding over months. It was happening in days. International observers began to connect the dots. The blockade was not just limiting oil exports. It was triggering a chain reaction inside Iran's economy that could reshape internal stability. Some analysts argued this was the intended effect: economic pressure designed to force political decisions. Others warned that such pressure can produce unpredictable outcomes, including escalation rather than compliance. Economic distress does not always lead to negotiation. Sometimes it leads to resistance. By the end of the day, one reality had become clear. The blockade had moved beyond ships and sea lanes. It had entered the financial bloodstream of the country. The rial's collapse was not just a statistic. It was a signal that the pressure was working, but also a signal that the situation was becoming more volatile, more fragile, and more dangerous. Because when a currency collapses, the impact is not contained to numbers on a screen. It spreads through every part of society, and in Iran, that spread had already begun. As the pressure on Iran intensified and the economic shock began spreading through its currency and internal markets, another key player was moving carefully but decisively behind the scenes. Israel was not at the center of the naval blockade itself, but its position in the unfolding crisis was critical. This was not just a distant observer watching events develop. This was a nation deeply embedded in the strategic balance of the region, calculating every move with precision. Because for Israel, this moment was not only about Iran's economy, it was about long-term security, deterrence, and the risk of escalation that could unfold at any time. Within hours of the blockade tightening, Israeli defense systems shifted into a higher state of readiness. Intelligence units increased monitoring across multiple fronts. Air defense systems were reinforced. Military command structures began reviewing contingency scenarios, not because conflict had already begun, but because the probability of miscalculation had just increased significantly. In modern conflicts, preparation often happens long before any visible action. And Israel, with its history of regional threats, does not wait for clarity, it prepares for uncertainty. The strategic concern was clear. When economic pressure is applied to a country like Iran, the response does not always remain economic. Iran has multiple ways to react, many of them indirect. It can activate regional networks, increase influence through allied groups, or shift the conflict into areas that are harder to control. That is why Israeli planners were not just watching the blockade, they were watching everything connected to it. Movements in neighboring regions, communication signals, changes in behavior across allied networks, all of it became part of the same equation. This is how modern deterrence works. It is not just about visible force, it is about anticipating invisible reactions. Coordination with the United States also became a key factor. Intelligence sharing intensified as both sides sought to maintain a unified understanding of the situation. This coordination is not new, but in moments like this it becomes more active, more detailed, and more critical. When pressure is applied at one level, it must be supported at others. Economic pressure without strategic alignment can create gaps, and in those gaps, risks grow. Israel's role was to ensure that those gaps did not appear in areas that could threaten its security. At the same time, Israel had to manage a delicate balance. Showing strength is important for deterrence, but showing too much movement can signal escalation. Military visibility sends messages, whether intended or not. Too little response can be interpreted as weakness. Too much can be seen as preparation for confrontation. Navigating that line requires careful signaling. That is why many of Israel's actions during this period were measured rather than dramatic. Reinforcement without provocation. Readiness without declaration. It is a strategy designed to maintain control in an environment where control can disappear quickly. Diplomatically, Israel also played a quiet but important role. Messages were being sent, not always publicly, but through established channels. These signals are often designed to prevent miscalculation. In high-tension situations, misunderstandings can escalate faster than deliberate decisions. A signal sent at the right moment can prevent a reaction that might otherwise spiral. Israel's objective was not just to prepare for conflict, it was to reduce the chances of it happening unintentionally. But even as diplomacy worked in the background, the reality on the ground remained tense. The blockade was increasing pressure, Iran's economy was reacting, markets were volatile, and every layer of the system was becoming more sensitive. In such an environment, even small incidents can carry outsized consequences. A misinterpreted movement, a delayed response, a misread signal, these are the moments that history often turns on. Israeli strategy is built around preventing those moments from turning into crises. There was also a broader strategic calculation at play. Israel has long viewed Iran not just as a regional actor, but as a long-term strategic challenge. Any shift in Iran's capabilities, stability, or external relationships is closely monitored. The blockade, by targeting Iran's economic core, introduced a new variable. If the pressure succeeded, it could limit Iran's ability to project influence. If it failed or triggered escalation, it could create new risks. Israel had to prepare for both outcomes simultaneously. That dual preparation is what defines its strategic posture, preparing for success and failure at the same time. As the situation developed, one thing became increasingly clear. This was no longer a single-layer conflict. It was not just economic. It was not just military. It was not just political. It was all of these at once, interacting in real time. And Israel was positioned at the intersection of those layers, managing risk while preparing for possibility. This is what makes such moments so complex. There is no single path forward. Only multiple scenarios, each with its own consequences. By the end of the day, Israel's position could be summarized in one word: readiness. Not panic, not escalation, but readiness. Ready for deterrence, ready for response, ready for uncertainty. Because in a situation where pressure is rising and systems are shifting, the ability to respond quickly can determine everything. And as the blockade continued to tighten and Iran's internal pressure grew, the next phase of this crisis was already beginning to take shape. The moment it became clear that the naval blockade was not a temporary signal but a sustained pressure move, global markets reacted with speed and intensity. What had started as a regional geopolitical development quickly transformed into a worldwide financial event. Traders across New York, London, Tokyo, and beyond began repricing risk in real time. Screens lit up with red and green flashes, volatility surged, and a single question dominated every trading desk: how far could this crisis spread? Because in modern markets, conflict is not just about location, it is about disruption. And disruption, especially in energy and trade routes, has a way of reaching every corner of the global economy. Oil was the first and most immediate signal. Prices surged sharply as soon as news of the blockade tightened. Energy markets are extremely sensitive to any threat around key shipping lanes, and even the possibility of restricted flows can trigger aggressive buying. Traders rush to secure positions, anticipating supply constraints and higher future prices. This was not just about current barrels. It was about expectations. If tankers faced delays, if insurance costs continued rising, if routes had to be adjusted, the entire supply chain would tighten. And when supply tightens, prices rise. The ripple effect began almost instantly. Stock markets around the world reacted with a mix of fear and recalibration. Major indices in the United States opened lower, led by declines in airline, logistics, and consumer sectors. Airlines, which are highly sensitive to fuel costs, dropped sharply as higher oil prices threatened margins. Shipping companies faced uncertainty over routes and insurance. Retailers and manufacturers saw selling pressure as investors anticipated rising input costs. The reaction was not uniform, but the direction was clear, risk was increasing, and markets were adjusting accordingly. In Europe, the response followed quickly. Major indices slipped as energy concerns combined with broader geopolitical anxiety. European economies, heavily reliant on imported energy, are particularly exposed to disruptions in supply routes. That vulnerability translated into market caution. Industrial stocks weakened, while energy producers saw gains. The pattern was familiar but intensified when energy risk rises. The market rotates. Some sectors suffer, others benefit, but overall volatility increases. Asia reacted overnight with similar tension. Markets opened under pressure, reflecting both the geopolitical risk and the uncertainty about how long the situation might last. Export-driven economies watched closely, knowing that any disruption in global trade routes could impact demand and logistics. Currency markets in the region also showed movement as investors reassessed risk exposure. In moments like this, capital flows quickly toward perceived safety and away from uncertainty. That shift was already underway. Safe haven assets became the center of attention. Gold prices climbed as investors looked for stability. Government bonds, particularly U.S. Treasuries, saw increased demand pushing yields lower. These movements are not random. They reflect a deeper behavior in financial systems. When uncertainty rises, investors seek assets that are less exposed to disruption. It is not about maximizing returns, it is about preserving capital. And in this environment, preservation becomes the priority. Currency markets added another layer to the story. The US dollar showed strength as a traditional safe haven, but its movement was more complex than usual. On one hand, global investors were seeking safety. On the other, the crisis itself was tied to US actions, creating a tension between confidence and caution. Other currencies, particularly those linked to energy exports, saw gains as oil prices rose. This created a fragmented but telling picture. Markets were not just reacting, they were repositioning. Sector-level movements revealed the deeper impact. Energy companies surged as higher oil prices improved revenue expectations. Defense stocks gained as geopolitical tension increased. Meanwhile, airlines, travel companies, and global logistics firms faced significant declines. Manufacturing stocks were mixed, reflecting both cost pressures and uncertainty about supply chains. Technology stocks experienced volatility as broader market sentiment influenced growth expectations. This was not a simple sell-off, it was a reallocation of capital based on shifting realities. Analysts quickly began framing the situation through a familiar but powerful lens. Markets can handle conflict. They can even handle short-term disruption. What they struggle with is sustained uncertainty around critical systems like energy supply and trade routes. The blockade introduced exactly that kind of uncertainty. It was not just a one-time event, it was an ongoing pressure point with unpredictable duration. That is what made the reaction so intense. The contrast between before and after the blockade was striking. Before, the situation was tense but contained. Markets were aware of regional risks but did not see immediate disruption. After the blockade, the risks became active. Supply chains were no longer theoretical vulnerabilities, they were potential points of failure. Energy prices were no longer stable, they were rising rapidly. Investor confidence shifted from cautious to defensive, and once that shift happens, it tends to reinforce itself. By the end of the trading cycle, one message had become clear across global markets. This was not just a geopolitical event, it was a systemic risk developing in real time. Every sector, every region, every asset class was being forced to reassess its position. The blockade had moved beyond the water. It had entered the financial system. And when financial systems react at this scale, the consequences rarely remain contained. They expand, evolve, and shape the next phase of the crisis.